On Friday, March 26, 2021, at 3 a.m. Eastern Time, the trading desks at Goldman Sachs and Morgan Stanley began unloading more than $20 billion worth of stock into a market that was still asleep. Block after block, ViacomCBS, Discovery, Baidu, Farfetch, Tencent Music, dumped at any price they could get. By the time New York opened, these stocks were in freefall. ViacomCBS down 27% in a single session. Discovery down 27%. The damage spreading across a dozen tickers. And the man whose positions were being liquidated? He wasn't at a hedge fund fortress in Greenwich. He wasn't on the 40th floor of a Manhattan tower. He was running the whole thing from a modest house in Tenafly, New Jersey, sitting in his home office, watching $20 billion of his personal net worth evaporate over 10 days. His name was Bill Hwang. Wall Street had never heard of him. The SEC had never seen his positions. And in the span of one weekend, this invisible man would inflict more than $10 billion in losses on the biggest banks on earth, and help set in motion the eventual destruction of Credit Suisse itself. This is the story of the Korean trader who spooked Wall Street from his bedroom. Sung-Kook Hwang was born in 1964 in South Korea, the son of a Christian pastor. His father had spent years working odd jobs, factory work, truck driving, anything to keep the family fed while he preached on Sundays. In 1982, when Bill was 18, the family immigrated to the United States, landing in Los Angeles with almost nothing. Bill didn't speak English well. He enrolled at UCLA and studied economics, grinding through courses while working part-time jobs to help cover tuition. He was not a prodigy. He was not the smartest kid in the room. He was a quiet, devout young man who attended church religiously and believed, deeply, that God had a plan for him. After UCLA, he picked up an MBA from Carnegie Mellon, and in 1996, at the age of 32, he walked through a door that would change everything. He landed a job at Tiger Management, the legendary hedge fund run by Julian Robertson. Tiger was the mountaintop of stock picking in the 1990s. Robertson was a billionaire, a North Carolina charmer who had built Tiger into a $20 billion empire by finding undervalued companies around the world and betting big. His specialty was Asia, Korea, Japan, China, markets most American investors couldn't even read the financial statements in. Bill Hwang could. He was Korean-born, fluent in the language, and he understood the culture. Robertson handed him a sector to cover and watched. Hwang was relentless. He flew to Seoul, sat in factory parking lots counting trucks, pored over Korean annual reports nobody else on Wall Street could decipher. Robertson saw something in him, a kind of quiet ferocity. By the late 1990s, Hwang had become one of Robertson's most trusted analysts on Asian equities. And when Tiger began to stagger under the weight of the dot-com crash in 2000, Robertson made a move that would define the next 2 decades of hedge fund history. He shut down Tiger and seeded his best people, the so-called Tiger Cubs, with capital to start their own funds. He gave Hwang roughly $25 million, and in 2001, Tiger Asia Management was born. Tiger Asia exploded. Within a few years, Hwang was managing over $5 billion, then $8 billion, then more than $10 billion at peak, one of the largest Asia-focused hedge funds in the world. He was shorting Japanese stocks, going long on Chinese banks, riding the commodities boom. He was generating returns that made other hedge fund managers jealous. Julian Robertson had been right about him. But here's the thing about Bill Hwang, and you need to understand this, Chavi, because it's the key to the entire story. He never stopped being the pastor's son. He lived modestly. He drove a used car. He poured millions into a charity called the Grace and Mercy Foundation, funding Christian causes, schools, anti-poverty programs. He prayed before trades. He told people he was investing God's money. And while other hedge fund kings bought yachts and threw parties in the Hamptons, Bill Hwang went home to his family and read his Bible. This was not a man who looked like a threat to the global financial system. In December 2012, the Securities and Exchange Commission dropped a bomb. They charged Tiger Asia Management, Tiger Asia Partners, and Bill Hwang personally with insider trading and market manipulation, specifically illegally trading Chinese bank stocks using confidential information. Bank of China, China Construction Bank. Hwang had gotten access to private placement share offerings, learned the pricing details ahead of the public, and then shorted the stocks before the offerings diluted them. Classic insider trading. And here's the part that matters. He didn't fight it. Tiger Asia and Hwang admitted it. They settled with the SEC for $44 million in penalties, paid another $16 million to criminal authorities, and in October 2014, Hong Kong regulators banned Hwang from trading in their market for 4 years. The hedge fund was dead. Outside investors pulled their money. By the end of 2012, Tiger Asia was winding down. And this is where most stories end. Disgraced hedge fund manager gets caught, pays a fine, fades into obscurity. Bill Hwang did not fade into obscurity. Bill Hwang did something far more dangerous. He took what was left, somewhere around $200 million of his own money, and he restructured. He shut down the hedge fund. He opened a family office. He called it Archegos Capital Management. Archegos is a Greek word. It means founder or prince or leader. And in the book of Hebrews, it's a title given to Jesus Christ. Bill Hwang, the pastor's son, named his new company after Christ. And then he went to work. Here's the mechanism, and I need you to pay close attention, because this is where Wall Street failed. When you manage outside investors' money, the SEC watches you. You have to file a form called a 13F every quarter, listing every stock position over a certain size. Regulators can see you, the public can see you, but a family office, a fund that manages only the owner's personal money, is largely exempt from those disclosure rules. You don't file a 13F. Nobody sees what you're holding. That was loophole number 1. Loophole number 2 was the instrument itself. Instead of buying stocks directly, Archegos used something called a total return swap. Here's how it works. In plain English, Archegos doesn't buy the shares. The bank, Credit Suisse, Nomura, Goldman Sachs, Morgan Stanley, buys the shares and holds them. Archegos pays the bank a fee, puts up some cash as collateral, and in exchange, Archegos gets all the upside if the stock goes up, and eats all the downside if it goes down. The bank holds the shares. So on paper, the largest shareholder of record is Credit Suisse or Goldman Sachs, not Bill Hwang. The public filings show the bank, they don't show Archegos. And critically, each bank only saw the slice of Archegos' exposure that ran through their own book. Credit Suisse didn't know what Nomura was holding for Hwang. Nomura didn't know what Goldman was holding. Nobody had the full picture. Nobody knew that one man, sitting in a house in New Jersey, was building the most concentrated, leveraged stock portfolio in the history of modern finance. By March 2021, Archegos controlled over $160 billion in total market exposure, on just $36 billion of its own assets. That's leverage of more than 4 to 1, sometimes 5 to 1, on highly concentrated, volatile stocks. Hwang was borrowing billions from banks to amass stakes so large that in some companies he controlled as much as 70% of the outstanding shares. ViacomCBS was his crown jewel. The stock went from around $13 in early 2020 to nearly $101 by March 22, 2021, a 600% run driven almost entirely by one buyer. Archegos. Hwang's personal net worth from that $200 million seed had ballooned to somewhere north of $20 billion. He was, for a brief and insane moment, one of the richest men in America. And nobody outside a handful of prime brokers had any idea. The peak lasted exactly as long as ViacomCBS kept climbing. On March 22, 2021, ViacomCBS announced a $3 billion secondary stock offering. The company was selling new shares at around $79 apiece. That diluted existing holders. The stock started sliding. It fell 9% that day, then more. Then analysts downgraded it. By Wednesday, it was down 27% on the week, and Archegos' swap positions were underwater. The banks started calling. Margin calls. Post more collateral, Bill, or we start selling. Hwang tried to hold. He couldn't. By Thursday, the calls were coming from every counterparty simultaneously. Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, UBS, Wells Fargo, all of them suddenly realizing the same client had enormous positions with all of them spooked, all of them racing for the exit at the same time. Friday, March 26. Goldman Sachs moved first. They block sold over $10 billion of Archegos-linked stock before the market even opened. Morgan Stanley followed. The fire sale was on. ViacomCBS cratered. Discovery cratered. Baidu, VipShop, Farfetch, Ikiyi, Tencent Music, all of it dumped into a market that had no idea why. Over 2 days, more than $20 billion in securities were liquidated. Archegos was wiped out. $20 billion in personal wealth, gone. 10 days. The damage to the banks was catastrophic and uneven. Goldman Sachs and Morgan Stanley had moved fast. They got out with minimal losses. Credit Suisse moved slow. They believed Hwang would post more collateral. They were still trying to manage the relationship while Goldman was already selling. Credit Suisse lost $5.5 billion, the single largest trading loss in the bank's 167-year history. It forced the bank to raise emergency capital, gutted its prime brokerage division, and became a wound that would never fully heal, a wound that contributed directly to Credit Suisse's collapse and forced rescue by UBS in March 2023. Nomura lost $2.9 billion, Morgan Stanley, nearly $1 billion, UBS, $774 million. The total damage to Wall Street exceeded $10 billion. From one man, in one house, in New Jersey. On April 27, 2022, federal agents arrested Bill Hwang at his home. The Department of Justice charged him with racketeering conspiracy, securities fraud, market manipulation, and wire fraud, calling it a $160 billion trading scheme, the largest such case ever brought against an individual. The SEC filed parallel civil charges. In July 2024, after a 9-week trial, a Manhattan jury convicted Hwang on all counts. On November 20, 2024, a federal judge sentenced Sung-Kook, Bill Hwang, to 18 years in federal prison. He was 60 years old. The pastor's son, the man who named his company after Christ, the man who donated hundreds of millions to charity while building a leveraged empire that dwarfed the GDP of small nations, walked out of a courtroom and into the federal prison system. The banks that lost billions paid their own fines. Credit Suisse ceased to exist. And the total return swap loophole? It is still, as of today, largely intact. Here is the thesis, Chavi, and it's not what you think. Bill Hwang was not simply greedy. Plenty of greedy people blow up accounts. Bill Hwang was something more specific and more dangerous. He was a man who believed he was right, who believed God had blessed his insight, and who used that conviction to justify taking risks that no rational person should ever take. He found a loophole in the system, the family office exemption, the total return swap, and he rode it to a scale that no regulator, no bank, no risk manager ever imagined possible. He didn't break the rules of leverage, he broke the spirit of them. And the banks? The banks failed because they were greedy too. Each one wanted Hwang's swap fees. Each one assumed someone else was watching the risk. And none of them wanted to be the first to cut him off and lose the business. That is the lesson. Leverage amplifies conviction until conviction becomes catastrophe.